Hello and welcome to our new Wilkins Southworth video. I'm Chris Wilkins. At Wilkins Southworth, we always explore the problem to ensure that you get the most proactive and best tax advice.
The subject of gifting money, trusts and inheritance tax, IHT, appears relatively straightforward on the surface. It's only when you start to look at timings, potentially exempt transfers, PETS, and chargeable lifetime transfers, CLTS, that complications may arise. To be clear, there are tax-efficient ways to gift money to a trust to avoid/reduce your inheritance tax bill. However, there are several issues to be aware of. Different types of transfers. For the moment, we will set aside the standard personal allowances and concentrate on the two main types of gifted money/asset transfers and the benefits of leaving part of your estate to charitable causes. Potentially exempt transfers, commonly referred to as PETs. This is a type of monetary or asset gift made to an individual or in some cases a trust, which will be exempt from IHT if those making the gift survive for a further 7 years. Chargeable lifetime transfers. This type of transfer into a trust is usually described as a CLT and should be considered in line with long-term tax planning. The effective CLT nil rate band is £325,000, after which there will be IHT considerations. The CLT limit is effectively refreshed every 7 years. Charitable donations. If an individual leaves more than 10% of their estate to a charity, they will automatically qualify for a reduction in the headline inheritance tax rate, down to 36%. Taper relief. CLTs and PETs would typically be free of potential inheritance tax if the donor survives at least 7 years from the transfer date. If they were to die within 7 years and the estate was above the inheritance tax threshold of £325,000, tax relief would be tapered as follows. In the first 3 years 40%, 3 to 4 years 32%, 4 to 5 years 24%, 5 to 6 years 16%, and 6 to 7 years 8%. We have also added the far right column to the table to show the discounted percentage of the full tax rate. This would still apply if the 40% IHT rate was adjusted in the future. Gifting money to a trust. It is important to recognise that different trusts have different aims and structures, but all will have a settler/trustor, trustee and beneficiary. You should take professional financial advice before setting up a trust and when looking to gift money in the most tax-efficient manner. Utilising your nil rate band. At the time of writing, each individual has what is known as a CLT nil rate band, which currently stands at £325,000. This is the maximum 7-year cumulative amount that can be transferred into a trust without any IHT liability. Theoretically, you can move up to £325,000 into one or more trusts every 7 years. As we've just discussed, if you die within 7 years of cash/asset transfers, they will be drawn back into your estate for IHT purposes, although taper relief may be applicable. If, for example, you only made one CLT of £325,000 into a trust and lived for more than 7 years after the transfer date, this could not be drawn back into your estate on death. Gift allowance. Each person also has an annual gift allowance, which allows them to gift up to £3,000 each tax year. This can be one gift of £3,000 or split between several parties. When the funds have been transferred, they are the full possession of the beneficiary, and they can't be drawn back into your estate. It is important to note that you can use the gift allowance for the current tax year and carry forward any unused allowance from the previous tax year. Therefore, if you have not used the gift allowance for the 2 tax years, you could make gifts totalling £6,000. Using both allowances. If you have not used your CLT nil rate band allowance in the previous 7 years, or made any gifts in the current and previous tax year, you could gift a total of £331,000 into a trust with no immediate tax obligation. Obviously, the situation would change regarding the CLT if you were to die within 7 years. Settling any inheritance tax liability. When looking at a CLT and PET, there appears to be a degree of overlap, which can be confusing. However, it's crucial to recognise the difference because the inheritance tax liability is allocated to different parties. Where pets are drawn back into the deceased estate because they died within 7 years of the transfer date, the recipient pays any inheritance tax liability on that element. Where an IHT liability occurs with a CLT, this is paid by the settlor, i.e. the donor of the gift, their estate. Timing is key. To demonstrate the potentially complex nature of gifting money to individuals and trusts, it's crucial to appreciate the difference between a CLT and a PET. Scenario. Transaction 1. Mary transfers £300,000 into a trust, CLT, for the benefit of her child Stephen. Transaction 2. 6 years and 364 days later, Mary makes an additional £200,000 gift to Stephen. Death. 6 years and 364 days later, Mary passes away. In this scenario, the gift of £200,000 falls within the 7-year period and is therefore deemed a failed PET. To calculate the inheritance tax payable, we need to go back 7 years from the £200,000 payment to see what element of the CLT allowance had been used. If no part of the CLT nil rate band had been used in the previous 7 years, then the £200,000 would count towards this, and there would be no inheritance tax to pay. As £300,000 of the total £325,000 CLT allowance had been used, only £25,000 could be brought forward and offset against the £200,000 gift. Consequently, this would create a chargeable gift of £175,000, against which inheritance tax could be charged, depending on the situation. In this scenario, if Mary had waited just one more day before transferring the £200,000 gift to Stephen, the original CLT allowance would have been reset to £325,000. As a consequence, the £200,000 failed PET could have been offset against the reset CLT allowance. Chargeable lifetime transfers above £325,000. If you were to transfer £500,000 into a trust as a CLT, with no other transfers in the previous 7 years, this would exceed the nil rate band by £175,000. In this situation, the settlor, the person transferring the cash into the trust, would be liable to a partial 20% inheritance tax charge. This equates to £35,000 and would be taken into account as a credit against any additional IHT liability on the settlor's death. Conclusion. As you can see, the subject of gifting money to trusts and individuals as a means of avoiding inheritance tax can be relatively complex. In the above example, not delaying the £200,000 gift by just 1 day created a chargeable transfer of £175,000. This would be added to the deceased's estate to calculate any inheritance tax liability. Waiting just 1 extra day would have brought the failed PET under CLT regulations and ensured the gift remained outside of the individual's estate. You must take professional financial advice when settling up trusts and considering gift transfers via CLTs and PETs. If you have any questions regarding inheritance tax issues and trusts, then please visit our website and leave a message. We will then get back to you as soon as possible. By the way, don't forget to subscribe to learn about other videos in this series.